Welcome to ES Gold. This is your daily outlook for gold, XAUUSD, for Monday the 6th of July, 2026. Today we analyze gold's massive jobs report rally, the cooling of Federal Reserve rate hike odds under Kevin Warsh, the drop in the US dollar index, structural support from China's central bank buying, and the critical technical levels for your trading today. Where gold stands today, spot is trading near 41.75 to 41.90, extending its strong relief rally. After hitting an 8-month low near 39.50, the metal has staged a near 6% recovery, reclaiming the 4100 handle and closing the holiday-shortened week near 41.88. The near-term momentum is bullish, but daily RSI is approaching overbought levels, suggesting a short-term consolidation may be needed. What changed heading into this week? The primary catalyst was last Thursday's weak U.S. employment report, which came in at just 57,000 payrolls, along with 74,000 in downward revisions. This week, data slashed Federal Reserve rate hike odds and knocked the US dollar index off its 13-month high down to 100.8. While the short-term trend has flipped to bullish, the medium-term trend remains capped by dynamic overhead resistance. Base case for today, neutral to bullish, but watch for exhaustion. The pivot level sits at 41.14, which is the key hammer level. While we hold above 41.14, the path of least resistance is to test the 4200 psychological level. A break above 4200 opens the door to 4254. However, if we lose 4114, it exposes support at 4059 and the 4000 level. Driver 1. Geopolitical risk. The ceasefire between the US and Iran, based on the 60-day Memorandum of Understanding signed in mid-June, is broadly holding. Strait of Hormuz shipping traffic has resumed, which has pushed oil prices lower and eased inflation concerns. The direct safe haven premium has drained out of gold, but the indirect benefit of lower inflation has eased Fed rate hike fears, acting as a net support for gold. Driver 2. The Federal Reserve. The Fed held rates at 3.5 to 3.75% at their June 17th meeting under Chair Kevin Warsh. The statement removed rate cut guidance, which initially boosted rate hike expectations. However, the weak June payrolls forced a rapid repricing in interest rate futures. CME FedWatch now shows September rate hike odds cut to about 50%, easing the immediate pressure on non-yielding assets. Driver 3. The dollar and yields. The US dollar index has dropped to a 2-week low near 100.6, currently stabilizing around 100.8. The rejection of the dollar index at its long-term downtrend resistance is working in gold's favor, lowering the opportunity cost for buyers. A continuation of this dollar softness is key to extending the gold rally, though any hot inflation data next week could reverse this trend. Driver 4. Inflation fundamentals. May CPI came in hot at 4.2% year-over-year, driven by energy costs. However, June CPI is not scheduled for release until July 14th, meaning inflation data is a dormant factor for today's session. With the Strait of Hormuz open and oil prices declining, future inflation expectations are cooling, which supports the narrative of a less aggressive Federal Reserve. The economic calendar for the week of July 6th. Following the jobs report volatility, this week presents a lighter, second-tier slate of data. Full liquidity returns today after the holiday weekend. Key events include the ISM Services PMI on Tuesday, the FOMC Minutes from the June 17th meeting on Wednesday, and initial jobless claims on Thursday. Expect gold to trade the interest rate repricing narrative with moderate volatility. Driver 5. Structural central bank demand. Underneath macro swings, structural official sector demand remains very strong. The People's Bank of China has accumulated gold for 19 consecutive months, the longest buying streak since 2015. China's reserves have reached 2,332 tons. Global central bank buying is projected at 750 to 850 tons in 2026, providing a solid floor under the gold market. Technical trend structure. Gold's short-term trend has turned up following the multi-day recovery above 4,100, and price holds above the simple moving average 20. However, the higher time frame trend remains bearish as gold trades below its 200-day simple moving average near 4,340. The 200-day average represents the primary structural cap and the trend flip line for long-term bulls. Technical momentum indicators. On the 4-hour chart, the 14-period RSI is near 70, which indicates overbought conditions and a near-term risk of a pullback or consolidation. On the positive side, MACD is rising in positive territory, and the money flow index shows steady capital inflows into gold. A hammer candle near 41.14 supports the uptrend continuation case during dips. Resistance levels above. The first cap is 4,202, the psychological pivot. A clean breakout above 4,202 opens 4,255, which is key swing resistance. Above that sits daily high projection at 4,314. The final targets for the week are upper supply at 43.76 and the weekly high projection at 44.41. Support levels below. First support is 41.57, where a break serves as a short trigger. Below that is 41.14, which is the key hammer level and must-hold support. Projected daily low is 40.59. The structural floor is the 40.08 level, and the ultimate support shelf is the weekly low and rally origin near 39.51. Your trading map for today. The buy zone for dips sits between 41.14 and 41.57 while they hold, targeting a test of 4,202, then 42.55. Fading rallies or selling short is favored if we see rejection at 4,200 to 42.55, with a stop above 42.60, targeting 41.14. Current price near 41.85 sits in the middle of these ranges. Scenario A, the primary path with a 45% probability, bullish continuation. Post-jobs report momentum and rising money flow keep the recovery alive. Gold holds above 41.57, leading to a test of 4,202 and potentially extending toward 42.54. A softer dollar index and cooling hike expectations underpin this path. The strategy is to buy dips near support. Scenario B, with a 35% probability, consolidation and pullback. The overbought RSI warns of a near-term pause as full liquidity returns to the market. Gold trades sideways to slightly lower, consolidating between 4,200 and 41.14. A shallow dip to the moving average 20 is healthy and does not threaten the short-term uptrend. The strategy is to buy supported dips. Scenario C, with a 20% probability, bearish fade. The jobs rally is treated as a counter-trend bounce into a dominant bearish higher time frame. A break below 41.14 invalidates the recovery, reopening 40.59 and the 40.00 psychological level. This path would be triggered by a re-strengthening dollar and hawkish Fed speak. The strategy is to sell a failure below 41.14. Risk management and themes to watch. As full market liquidity returns after the holiday, monitor whether the post-jobs bounce has genuine follow-through. Key risk themes include the dollar's ability to hold below 101, Wednesday's FOMC Minutes, and services data. Keep position sizes conservative and manage risk tightly ahead of next week's crucial CPI inflation report. The bottom line for July 6th. Gold has reclaimed the 4,100 level following a very soft jobs report, but faces a heavy macro ceiling and overbought short-term conditions. The near-term bias is neutral to bullish, with the line in the sand at 41.14. We buy dips towards support while it holds, watch the 4,200 pivot above, and manage risk carefully ahead of central bank events. That is your daily gold outlook for Monday, July 6th, 2026. If this analysis helped you trade, please like, subscribe, and hit the notification bell so you never miss an update. This is for educational purposes only and does not constitute financial advice. Trade safely, protect your capital, and we will see you in the next outlook.